Hello everyone, and welcome back to Finance in Focus. I'm Brady Hansman, and today we're discussing a topic that affects every American, whether you're retired, still working, or simply trying to grow your wealth over time. That topic is the national debt. As of today, the United States owes nearly $40 trillion. That's a number so large it's difficult to even comprehend. To put that into perspective, the debt is increasing by billions of dollars each and every single day. And according to many projections, it could exceed $50 trillion within the next decade. Now, having debt by itself isn't necessarily the problem. The bigger concern is the cost of servicing that debt. For years, the government was able to borrow money at extremely low interest rates. But after inflation surged in recent years, interest rates rose significantly. That means the government is now paying substantially more in interest expenses than it did just a few years ago. Some economists refer to this debt as spiral. The government borrows money which increases interest expenses. Higher interest expenses create larger deficits, which require even more borrowing. The cycle can continue indefinitely unless something changes. So what options does the government have? Generally speaking, there are three. The first option is reducing spending and increasing taxes. In theory, this is the most straightforward solution. Spend less money, collect more revenue, and gradually reduce the deficit over time. The challenge is that these decisions are rarely popular politically. Significant spending cuts affect programs people rely on, while tax increases tend to face resistance from voters. The second option is defaulting on the debt. For most developed countries, especially the United States, this is considered highly unlikely. The US dollar remains the world's reserve currency, and treasury bonds are still viewed as some of the safest investments globally. That leaves the third option, which is where much of today's discussion focuses on: inflation. Historically, governments have often reduced the burden of debt through inflation. Think about it like this. Imagine someone borrowed $10,000 many decades ago. While the debt amount remains the same, the value of money changes over time. What once represents a significant amount of purchasing power becomes much easier to repay years later. The same principle can apply to government debt. If inflation remains higher than interest rates for an extended period, the real value of that debt gradually shrinks. This concept is sometimes referred to as financial repression. In fact, the United States used a similar strategy following World War II. After the war, debt levels were extremely high. Interest rates were kept relatively low while inflation remained elevated. Over time, the debt burden declined relative to the size of the economy. Some analysts believe we could see a similar approach emerge over the coming years. Another factor investors are watching closely is the Federal Reserve. Future Fed leaderships will play a major role in determining interest rate policy. Some policymakers argue that lower rates could reduce government borrowing costs and support economic growth. Others worry that lowering rates too quickly could reignite inflation. There's also a growing belief among these economists that advancements in artificial intelligence could boost productivity and economic growth enough to help offset portions of the debt burden over time. Whether that happens remains to be seen. Another point worth discussing is inflation data itself. Many Americans feel that their personal cost of living is rising faster than official inflation reports suggest. Part of this comes from how inflation is calculated. Government agencies use various methodologies and adjustments when measuring inflation, including substitutions when consumers switch to lower cost alternatives and quality adjustments when products improve over time. While these methods are accepted economic practices, they can sometimes create a disconnect between official inflation figures and what people experience in their everyday lives. So what does this all mean for investors? First, it's important not to panic. The national debt has been a concern for decades, and markets have continued to grow through multiple economic cycles. Second, understand that cash sitting on the sidelines may lose purchasing power over time if inflation remains elevated. Historically, owning productive assets such as stocks, businesses, real estate, and other investments has helped. Investors stay ahead of inflation over long periods. Finally, focus on things you can control. You can't control government spending, you can't control Federal Reserve policy, can't control inflation, but you can control your savings rate, your investment strategy, your tax planning, and your long-term financial decisions. At the end of the day, understanding these economic trends helps you make more informed decisions and avoid being caught off guard when policies change. Thanks for watching another episode of Finance in Focus. We'll catch you in the next one.